I don't think that we're going to see that silver come back to the market unless silver is at much, much, much higher prices. So, as in my point of view, from my point of view, for all intents and purposes, for quite some time, that silver's off the market. At $23, I do not see, any kind of substantial portions of that physical silver buying, investment buying, coming back to market. Fair value of silver, just physical silver, I'm going to say probably somewhere around high 20s. $26, $28 at least, if all-in costs are around 22. So I think that would be more realistic.
Silver declined slightly to $24.90 during Thursday's European session, retreating from a recent three-month high of $25.16. This dip coincides with market apprehension surrounding the release of the United States Producer Price Index and retail sales data for February, which are expected to offer insights into the inflation outlook. Market analyst Peter Krauth highlights silver's current state, noting that while it trades at approximately half its peak price, production costs persist around $20 per ounce, signaling potential undervaluation. Despite this, silver's trajectory suggests robust near-term demand, as evidenced by its approach to a 10-month high of $25.90, set on December 4th. Additionally, the 20-day Exponential Moving Average, at approximately $23.80, is on an upward trend, further indicating bullish sentiment. Krauth attributes silver's capped price movement to several factors, including potential market manipulation, investor sentiment shifts, and industrial demand fluctuations. Notably, despite structural deficits in the silver market, with demand outpacing supply, the price remains constrained. Currently, at 86-1, the gold-silver ratio illustrates the disparity between the two precious metals. Reflecting on recent economic events, Krauth mentions how the ratio soared to nearly 93-1 amidst the Federal Reserve's rate cuts and quantitative easing measures aimed at stabilizing an economy rattled by previous rate hikes. However, as gold and silver rallied, the ratio declined to around 64-1, aligning with historical norms. Krauth emphasizes the significance of the gold-silver ratio, particularly when it drops below key thresholds like 80. A diminishing ratio implies silver's outperformance relative to gold, potentially signaling a favorable buying opportunity for silver investors. Join us as we explore Peter Krauth's insights. Stay updated by subscribing to our channel and activating notifications. Thank you.
Silver is still about 50% below its nominal all-time high, around $50, which it twice reached back in 1980 and then again in 2011. And if you look at the cost, the all-in cost to produce an ounce of silver, we're up in the at least low 20s. So the margins are quite thin. And I mean, it actually, in my view, it'd really be hard to find a better bargain right now. Some of the best noted investors, speculators as well. The market's become stupidly cheap, in fact, in the silver space.
Can you elaborate on that? Why is it stupidly cheap?
Why? Just because it's so close to its production cost. Look at uranium. Uranium, doubled in the last 6 months or so. It traded at what, $20, $30 for a matter of months or years. And we know that all-in production was at least $60, probably higher. So it traded at half its production cost for an extended period of time, and we're close to those levels. That's why I think the downside in silver is extremely limited. Silver always lags gold, and I think that's more the investment demand side to silver. When gold moves because of investment demand, it gets the headlines. It's the king of assets, the king of metals, and so everyone pays attention to that. And when gold starts to rally significantly, let's assume for a moment gold went to 2,300, 2,500. Let's say it did that this year. That would generate a lot of excitement. People would be sort of flocking to gold. We'd start to see, the gold price appearing on CNBC on a daily basis, and then people would start paying attention to gold, look at it and say, obviously, there's a bit of FOMO involved, and they'd want to get a piece of the action. And especially if stocks are, let's say, suffering at the same time, they're looking for a market that's doing well. They're going to look at gold and they're going to say, wow, an ounce is setting me back $2,500. What else can I get? And silver, if silver was even $30 or $35 at that point in time, That's a massive bargain compared to gold. And we even know, with the gold silver ratio, that would still be a huge bargain. I think that you'd have considerable interest sort of bleeding into the silver market. And I think that's why you get silver catch up and then eventually outpace gold in bull markets, for the investment demand side of it. Then we've got the whole sort of industrial demand side. And I don't know if you want to go there, but we've talked about multiple times about why is the silver price sort of trading in a consolidated range for the last 3 years if the outlook is so bullish, right? We're facing structural deficits in the silver market. 1.2 billion ounces of demand a year, 1 billion ounces of supply a year. So where is the silver coming from? How come the price has been, is looking like it's capped? Well, I think through research, I've more or less found the answer to that. When you see the ratio, to be sort of a bit more cautious and conservative about it, when you see the ratio fall back from above to below 80, and you see it consistently move down from 80 and downwards, normally what you're getting is you're getting silver catching up. Obviously, it's catching up to gold on a relative basis, but you're getting both metals doing well. So when the ratio falls, most of the time it's actually, and below 80, most of the time both metals are doing well, but silver is just doing better. It's actually rising faster than gold. So that's what I would look for the ratio to fall back below 80 and to keep falling from that level. That's when you want to get more aggressive on silver.
Last year, the collapse of Silicon Valley Bank and the Israel-Hamas war served as a significant catalyst, propelling gold to new heights alongside other events. According to the World Gold Council, these events contributed to a 3% to 6% increase in gold's performance over the year. As we look forward to 2024, the landscape remains fraught with challenges. Primary elections loom in key economies like the US, the EU, Taiwan, and India, fostering political uncertainty that may heighten the demand for safe haven assets like gold. Peter Krauth emphasizes the pivotal role of substantial central bank purchases, which constitute approximately 1/5 of the annual gold market, in bolstering gold's resilience amid a challenging economic climate. However, despite robust demand from central banks and sovereign investors, this interest has not proportionally translated into gains for gold equities. Leading analysts express unanimous optimism regarding gold's performance in 2024, foreseeing sustained purchases from central banks as a key factor in maintaining its price trajectory. The WGC, in its Gold Outlook 2024, anticipates that even if 2024 falls short of the soaring highs witnessed in previous years, any uptick in buying activity above the norm should provide an additional boost to gold's prospects. Let's get back to the interview.
Something I'd like to point out on gold is that, part of the research I do on a daily basis, it's clear that gold's been extremely resilient. And especially if you consider what's been happening with inflation, that inflation and real rates have stayed high. We've had this disconnect that has not happened before when real rates become weaker, that gold, or I should say when real rates are high, that gold stays resilient the way it has been. So that's a disconnect that has not typically happened before. And I think that has been triggered by the US weaponizing the dollar, making, freezing Russian assets. And you have the rest of the world's central banks and large sovereign investors looking at that and saying, I need more exposure to gold. So the gold buying has been dramatic. The last 2 years have seen huge outsized buying by central banks. I think it was 1,082 tons bought by central banks in 2022, something like 1,037 tons bought in 2023. So this is 1,000 plus tons a year for 2 years straight, very much outsized compared to the prior years. And the gold market is 4,700 tons a year. So 1,000 out of 4,700 tons is just above 20%. Did the math and I said, in the last 2 years, 1 out of every 5 ounces of gold was bought by a central bank. That is uncharted territory. We've not seen that before. That, I think, has made the gold price extremely resilient, despite the fact that we have positive real rates. And I think that's one of the reasons we've seen some of the equities lag. The interest has been from sovereign buyers, and it hasn't translated into the equities. If you look at what's happened with silver, if we could switch gears for a moment, silver has been quite resilient. I put together a chart that I thought was really interesting, where I looked at what happened when the Fed started raising rates in early 2022, and what happened to the silver price. Well, interestingly enough, silver was already up. It was right around $23 or so, and then it started to back off right around when the Fed started to raise rates. But it stayed in a range. It's been sideways in the range since early 2022, between about say $23 and $20 and $25. Considering this was the most aggressive rate hiking cycle in something like 50 years, silver has actually been pretty resilient. I don't think that we're going to see that silver come back to the market unless silver is at much, much, much higher prices. So, from my point of view, for all intents and purposes, for quite some time, that silver's off the market. At $23, I do not see, any kind of substantial portions of that physical silver investment buying, coming back to market. Fair value of silver, just physical silver, I'm going to say probably somewhere around high 20s, $26, $28 at least, if all-in costs are around 22. So I think that would be more realistic.
Silver has demonstrated a notable ascent in the past month, marking a gain of nearly 12% and once again surpassing gold in performance. However, despite this impressive surge, silver still holds significant potential for further growth. While gold has achieved new record highs, silver still lags, trailing approximately $5 below its 2020 peak and a substantial $25 per ounce below its all-time high. How might the recent performance of silver relative to gold impact investor strategies moving forward? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.